Hello and Assalamualaikum. My name is Nurul Ain Farha. Today I would like to answer the question number 1. Is a low or high inflation rate a clear indicator of a good or bad economy? First thing first, we have to understand what is inflation. Inflation measures how fast prices rise over time. A high inflation rate means prices increase quickly, reducing people's ability to buy things. A low inflation rate means prices rise more slowly, but it doesn't always mean the economy is strong. High inflation. When inflation is high, purchasing power drops because wages often don't keep up with price increases. Cost of living rises, making it harder for people to afford necessities. High inflation usually points to an overheated economy where demand is much more higher than supply. When the inflation is low, it can be a sign of economic stability, but it can also point to a weak demand. For example, Malaysia's current inflation rate of 1.5% may be linked to people or businesses spending less. This could mean the economy is slowing down. Deflation or negative inflation can be even worse. It leads to delayed spending because people expect prices to drop further. This causes businesses to stop investing and leading to more economic problems. As the conclusion, the inflation rate alone isn't a reliable indicator of an economy health. Context matters. A low rate could mean stability, but it could also signal economic problems. Balance is the key. Both high and low inflation have risks. So that's all from me. Thank you, and I'll pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Shazmira binti Muhammad Sani. My ID number is 23110092. So I would like to discuss question number 2. The article discusses many forms of inflation and related economic problems. One sort of inflation is cost-push inflation, which occurs when rising production costs such as labor or raw material prices drive up the price of goods and services. This was the situation during the East Asian economic crisis of 1997-1998, when inflation in Malaysia soared to 5.3% due to rising production prices. This type of inflation is usually generated by the supply side forces that push prices higher. Another type described is demand pull inflation, which is more implicit in the essay. This type happens when the demand for products and services exceed the supplies, causing the price hikes, while the essay focuses on the lowering demand during the crisis such as COVID-19 pandemic. Demand pull inflation may occur in healthy economic times when consumer and company spending increases, pushing inflation. The article also discussed deflation, which is a negative inflation rate that means prices are falling rather than rising. This occurred in Malaysia during the COVID-19 epidemic when inflation plummeted to negative 1.1% due to a major decline in demand induced by company closure, travel restrictions. The essay cautions about the preludes of deflation, citing Japanese lengthening era of economic stagnation caused by projected deflation. A less obvious notion explored is disinflation, which refers to declining pace of inflation. In this instance, prices continue to climb, but at slower rates. The article states that inflation has been steadily declining since August 2022, indicating a period of disinflation. This is not the same as deflation, but it does suggest a reduction in price increase, which could indicate a cooling economic. While not explicitly mentioned, the price alluded to deflation, a state of stalled economic development and rising prices. The article presents a situation in which consumer and company would have deteriorated, implying that low inflation paired with a slow economic growth may be a symptom of stagnation. Stagflation is a risky economic scenario because it combines high prices and poor growth, making it difficult to address. Understanding the different types of inflation and deflation is critical for evaluating an economy's health, as low inflation does not always imply favorable outcomes if it caused by weak demand or economic stagnation.
Assalamualaikum, my name is Nurul Iman binti Jamaluddin. ID number SMK23110047. First, let's talk about monetary policy. The article mentions that Malaysia's inflation rate is low right now because people and businesses are spending less. This means the central bank, which is Bank Negara Malaysia, could raise interest rates to control inflation. By increasing interest rates, borrowing becomes more expensive, which can reduce spending and slow down inflation. But since demand is already low, the central bank needs to be careful as raising rates too much could harm the economy even more. Next, we have fiscal policy, which refers to how the government controls spending and taxes. The article explains that both consumer spending and Malaysia's trade balance have dropped, showing a weaker economy. One option for controlling inflation is for the government to reduce public spending or increase taxes. This would help lower demand and help control price. However, because the economy is already slow, the government needs to avoid cutting too much or raising taxes too high, so they don't worsen the situation. The article also mentions cost push inflation, which happens when production costs rise, causing prices to increase. One way to control this type of inflation is through supply-side policies, such as giving subsidies to businesses on important goods like fuel or food. This can help reduce costs and prevent prices from rising too quickly. Another option is to improve productivity by helping businesses become more efficient, which can also keep prices stable. Although the article doesn't directly talk about it, the shrinking trade balance shows that imported goods might be getting more expensive due to the weaker Malaysian ringgit. To control inflation caused by rising import price, the central bank could step in to stabilize the currency. This would make imports cheaper and help lower inflation. Lastly, the article warns about the risk of deflation, which is when prices fall too much. This is dangerous because it can cause people to delay their spending, which slows down the economy even more. To avoid this, the central bank could set a clear inflation target. For example, between 2 to 3%. By doing this, people know what to expect, and it helps keep inflation at a stable level. In conclusion, based on the article, effective policies to control inflation in Malaysia include adjusting interest rates, managing government spending and taxes, providing subsidies, stabilizing the currency, and setting an inflation target. Each of these measures would help control inflation while ensuring the economy doesn't slow down too much. That would be all from me. Thank you.
Assalamualaikum, my name is Nur Hafrina Ardini. My ID number is SMK23110065 and I'm from DMK 3B. And today, I will describe the potential consequences of prolonged reduction of inflation. Do you know that the decreasing inflation rate can have significant effect on various asset classes and economic activities, especially for investors? Here is how the point mentioned in the context of decreasing inflation apply to different areas. So firstly is stabilizing prices. For businesses, when inflation decreases, business experience more predictable costs, which can lead to improved financial planning. Meanwhile, for investors, a stable pricing environment makes it easier for businesses to operate, which can lead to better business performance over time. If company can maintain a stable cost while growing revenue, this can positively impact earning and thus the stock prices of those companies. A stable business environment is typically favorable for investment, as it reduces risk and help ensure consistent returns. Second is rate cuts. For central bank, lower inflation make it more likely that central bank will reduce interest rate. This is because central bank often raise rates to curb rising inflation and lower rate to stimulate economic activity. When inflation decreases, there are less pressure on central bank to keep rates high, and they may reduce them to encourage borrowing and investment. Meanwhile, for businesses, when interest rate decreases, the cost of borrowing becomes cheaper. Businesses can take advantage of lower borrowing costs to fund expansion projects, invest in infrastructure, or innovate. This can potentially lead to increased revenue growth and profitability over time. Meanwhile, for investors, lower interest rate generally increase the attractiveness of stock and other investment, as borrowing becomes cheaper and companies have more access to capital. Next is fixed income. If an investor holds fixed income assets such as bonds, the value of those assets may increases as rates drop. This could lead to gains in the bond portfolio even if the investor does not sell the bonds. Fixed income investors could also benefit from capital appreciation in addition to receiving interest payment, particularly if they hold a long-term bond and higher rates. And then lastly is equity. For equity investor, when inflation is low, the return on other investments such as saving accounts or money market fund tend to be lower. As a result, equity become more attractive because they can offer higher potential returns. With lower inflation, the company can borrow at cheaper rates, boosting their ability to invest in growth and increasing their profitability. In summary, decreasing inflation can slow down the economy by reducing consumer spending and business investment. This can lead to stagnation as seen in Japan's deflationary period. While stable prices may improve business predictability and investor confidence, low inflation limit central bank ability to stimulate growth. A balanced approach to managing inflation is crucial for fostering economic recovery. That's all from me. Thank you.
Jadi nama saya Binti Fauzi from the MK3B. I'm gonna present about question number 4. Describe the potential consequence of product reduction of inflation. So for my answer for this question is less spending. It is because if a consumer expect prices to continue falling, they may postpone purchases, waiting for better deals. This reduce overall demand, slowing economic activity. And it will business investment drops too, because firms may delay investment in production and innovation, anticipating lower future revenues. This can lead to a decline in the job creation and economic growth. For example, in Japan long period of deflation, consumer spending dropped as people expected prices to keep falling. Many delayed purchases of big items like electronics and cars. This led to lower sales of retailers, who then reduced their inventory and investment. Business also slow hiring and wage increase, contributing to a stagnant economy. This cycle of less spending made it hard for the economy to recover, showing how expectation of falling prices can lead to reduced consumer activity. So next point, it will stagnation and economy slowdown. Japan experience with long-term deflation show the risk of low inflation. When prices keep falling, people and business spend less, leading to weak demand, little investment, and stagnant wages. This can trap the economy in slowdown, making it hard to recover and grow. So an example of a stagnation and economic slowdown in Japan can be seen during the lost decade in the 1990s. After the economic crash, deflation set in, causing people to expect price to keep falling. Many consumers and business decided to hold off on spending and investing, thinking they will get better deals later. This led to low demand and minimal investment, which resulted in stagnant wages and fewer job opportunities. The economy struggled to grow, showing how low inflation and deflation can trap an economy in cycle of underperformance. So the next one is monetary policy constraints. It is because central bank usually cut interest rates to boost the economy during a tough time. However, when inflation is very low or negative, there isn't much room to lower rates future. This makes it harder for monetary policy to work effectively in improving the economy. An example of a monetary policy constraints is seen in Japan after 2008 financial crisis. The Bank of Japan lowered interest rate to near zero to boost the economy. However, with inflation remaining very low or negative, there was a little room to cut rates future. This made it hard for the central bank to encourage spending and investment. As a result, Japan struggled to recover from the economy downturn, showing how low inflation can limit a central bank ability to act effectively. So, for the conclusion, I think while a declining inflation rate can offer temporary relief from high living costs, product reduction may be a warning sign of a deeper economic problem. As the article suggests, policymakers need to carefully monitor the situation to avoid sliding into deflation, which can trigger a downward economic spiral. Moderate stable inflation is essential for healthy economic growth and sustainable development.